Good morning. Thank you for tuning in to today's webinar on IPO Readiness. My name is Diane Gilliland, and I will be moderating today's session. We've got a great lineup of speakers, but before we get started, I wanted to review a few housekeeping items. Up on your webinar pane, we have a Q&A feature. Just press the orange arrow to expand your webinar and type in your questions. And we just encourage you, if one comes up, just go ahead and type it in, and we'll get to as many of those as possible at the end of the session. All right, so let's talk about your audio settings, just for the most beneficial settings. If you're tuned in through your computer, press mic and speaker mode, and if you're tuned in through your telephone, click the telephone mode. It'll just prevent you from having an echo in the background. All right, so if you're logged on today for California CE, I have a couple things that we need to review for you to qualify, and that is to be on your own personal computer, no PDAs, and logged in with your unique URL, and be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar, and then respond to 75% of the polling questions. We'll have 5 throughout the webinar, and then at the end, you'll need to just complete the evaluation survey. All right, so today we're going to meet a few objectives, and we will summarize the recent IPO market and assess which attributes the Jobs Act companies are leveraging now after a year and a half of being passed. And then we'll describe the advantages and drawbacks of choosing an IPO strategy for growth and examine several readiness considerations, common misunderstandings, and potential missteps to avoid. And then we'll break down the key steps in the readiness timeline and prioritize for success. So I'd like to introduce 3 of our speakers today, and our first speaker is John Dunnigan. He's a CPA at Armanino, and he has over 30 years of financial executive experience, operations and consulting experience in the public and private sector. He has held positions as Chief Financial Officer, Vice President of Finance and Administration, Treasurer, Controller, and Director of Operations. His area of expertise is helping fast-growing companies with all financial functions, including process re-engineering, debt financing, equity fundraising, information systems, SEC and investor reporting, mergers and acquisitions, divestitures, and cost reduction programs. John, thanks for joining us today. And our second speaker is Matthew Armanino. He's a CPA at Armanino. He heads up the technology audit practice, and he has supported more than 50 technology sector transactions. Matt has industry experience as controller and VP of finance, and prior to Armanino, he served in the technology practice at the Big Four in Boston, Palo Alto, and San Jose. He's a recognized subject matter in the area of revenue recognition, business combinations, and equity accounting. Matt, thanks for joining us.
You're welcome.
Our third presenter is Jeremy Suharski. He is the Governance, Risk, and Compliance Practice Leader at Armanino. Jeremy's background helping companies optimize their compliance programs has helped his consulting philosophy and approach. Jeremy believes controls and processes should strike the proper balance between the need to protect a company while not being unduly onerous and restricting their ability to innovate. In applying this approach, Jeremy has led over 50 SOX implementation and optimization projects. Jeremy, thanks for joining us.
Thanks, Diane.
And I will turn the program over to you to review our agenda.
Outstanding, and thanks everyone for joining us this morning. This presentation overview very much aligns with the learning objectives that Diane just spoke to here momentarily ago. We're going to touch briefly on what the IPO market looks like, give you some updates. There's been a lot of good buzz really over the last 18 months with IPO markets opening up, some very high-profile IPOs last year in terms of Facebook. This year, expected by the end of the week. Twitter is expected to list by the end of the week, so a lot of really high-profile ones. And even setting those aside, there's a significant number of very, very strong IPOs that have occurred over the course of the year. So we're going to touch on those and explore the Jobs Act briefly, less from the perspective of what is the Jobs Act, because at this point, 18 months removed, everybody pretty much knows what the nuts and bolts of it are, but really what are the pieces we're seeing clients take advantage of, and what could you or should you be looking at as you consider your path to IPO. From there, we're going to transition into looking at what are the strategic reasons for pursuing an IPO, touch on the advantages and disadvantages, and then from there move into the most appropriate way, the most expeditious way to go about the execution of IPO readiness. And with that, let's go ahead and start with our first polling question.
All right, our first polling question today is, what are your IPO liquidity event plans? A, 6 to 12 months, B, 12 to 18 months, C, 18 to 24 months, and D, undecided. All right, we'll give you just a few minutes to enter your answers, and I'd like to make a correction on one of our speakers today. I mentioned Matt Armanino, but I apologize. The speaker that we have with us today is Matthew Peralt, Technology Audit Practice Leader. All right, we'll give you just a few seconds to get your answers entered, and just know that you'll need to answer at least 75% of those questions by the end of the webinar. All right, so we're getting ready to close the polls in 5, 4, 3, 2, 1. Thanks a lot. Jeremy?
Let's take a look at the results here. There's no right or wrong answer here. What we see here is pretty similar to what we see in our client base. Handful of organizations looking at the next 6 to 12 months. A much larger number really looking at the 18 to 24 month range, and that's really what we've seen most consistently across our client base, really looking out 1 to 2 years. And not surprisingly, there's a handful that are undecided. So as we go through the discussion today, the reason that we are specifically looking at these various buckets is there's very specific things that organizations should be looking at in each of those time frames, which we're going to explore as we go through the discussion today. Excellent. So let's start off with maybe discussing a little bit about what the IPO market looks like. As we sat here and did a similar presentation last year, Facebook had just gone out, raised a significant amount of capital, and then watched its stock plummet. It has since rebounded. But the expectations from pretty much all analysts last year was that coming out of 2012 into 2013, the expectation was for IPOs to increase in 2013. And you can see the numbers there. In total, 2012 had about $43 billion in capital raised with 128 deals. More deals, and the 2013 data there is representative of IPOs up through about mid-September. Far less capital raised, but more deals done. And really that's, if you were to take Facebook out of the 2012 numbers, it's really a much better comparison. And you can see really analysts were right on. There's far more deals. We're looking to get back to IPO numbers that we were seeing 8 to 10 years ago in terms of total deals and total capital raised. And for comparative purposes as well, really one of the key focuses is in the software space, which is very relevant here in the Bay Area and the Silicon Valley. It's the third largest industry segment for IPOs, and really to note, it's the top average first-day return and the top average total return, outpacing both energy and healthcare, which were really, biotech, which are the top two industry segments for IPOs. So really, what we're seeing here is the IPO markets are much more open, and access to capital through an IPO is becoming much easier than it has been over the last 5 years. So what does that really mean to you and your organization? Ultimately, what it means is making sure that you've got a realistic expectation and a really realistic plan put together to be able to achieve readiness when the IPO markets are most advantageous for you. And so as we look at some of the responses that we saw, whether it be 6 to 12 months, 18 to 24 months, all indications are that the IPO markets are going to continue to be very favorable for organizations that have a compelling story and a compelling business model to go raise public funds. So as we mentioned, one of the things we wanted to touch on today was the Jobs Act. As most of us know, this was an act passed back in April of 2012, signed into law. The intended impact really was to make it easier for organizations to get out and go public, to raise money through initial public offerings. The impact, depending on how you look at it, has been somewhat varied. If you looked at really what the law intended to do, it did a variety of things for organizations looking to go public. It allows you to have meetings with accredited investors during the quiet period where before you were not allowed to. It reduced your requirement for audited financials from 3 years to 2 years. delayed your 404B opinion, and exempted you from some other requirements. It's interesting though, as you look across all of these requirements, really what we've seen in the clients that we work with are three primary impacts. Number one, it allows for confidential registration. We've seen this really across the board with all of the organizations we worked with over the last 18 months. I don't know that I've worked with any organizations that have not taken advantage of the confidential registration. John and Matt, I don't know if you guys have come across any in your travels, but personally, every organization that I've been working with that is pre-IPO, moving the direction of a public offering, all of them have taken advantage of the confidential registration.
Yeah, the 5 or 6 we've been working with over the last few months have all been confidential. So I think it's clearly the most popular aspect of the law that people really are enjoying and using.
Yeah, absolutely. And really what I think that does, it helps to remove some of the public pressure that would commonly be associated with announcing to the world that you're pursuing an IPO. It allows you to go about your business in a little more expeditious manner because you're not worried about the same implications that come along with announcing that publicly, especially in the age of social media and how quickly news is going to travel through sort of non-standard media outlets. The other piece, surprisingly, that we don't see being taken advantage of is the audited financial requirement. As I mentioned, the Jobs Act reduced that from 3 years to 2 years. Every organization that I've been working personally with over the last 18 months, I've been working with about 8 to 10 organizations actively pursuing an IPO in the next 12 months. None of them have taken advantage of this. All of them have chosen to have a full 3 years of audited financials completed because their concern, their perception is that it's going to be viewed negatively by the investment community if they do not have 3 years. Despite what the law says, their concern is that it's not going to be viewed favorably. So they go ahead and they pursue a full audit of a full 3 years, very much in the way they would have prior to the Jobs Act. And then the last area that we're really seeing taken advantage of almost to a fault is the requirements around SOX 404. Now, the first thing that everybody said when the Jobs Act was passed is, hooray, we don't have to do SOX anymore. As you dig in and start looking at it, that's not necessarily the case. Effectively, what it does is if you register as an emerging growth company, it eliminates your requirement to have a 404B opinion issued, meaning you do not have to have your external auditor issue an opinion over your system of internal controls. What other organizations have done now is they've become very lax with their 404A compliance, meaning getting the program in place. And what our caution is to organizations is you really need to be looking at making sure you get your controls in place, documented, make sure that you have a way to evaluate them prior to your first annual filing. Because at the end of the day, the organizations that perform the best post-IPO are those that have their processes solidified and in place really up to 12 months in advance of their public offering. So this is something that, as a strong caution to organizations moving in the direction of going public, absolutely be looking at getting your 404A compliance in place early and leveraging as long of a runway as you can. And with that, let's pause briefly and let's touch on our second polling question here.
All right. What is your experience level with taking a company public? What is your experience level with taking a company public? A, 2 or more IPOs. B, 1 or more IPOs. C, gearing up for my first IPO. Or D, researching the process, or you're not sure yet? All right, we see lots of answers coming in. Great. I just wanted to let you know at the end of the webinar we'll have the recorded session available along with the slides. You'll be able to share with your colleagues or review afterwards. All right, so we'll get ready to close the polls here in 5, 4, 3, 2, 1. Right.
All right, and we can see the majority, well, the largest majority of respondents said gearing up for my first IPO or just researching the process. So, I think it's good that you folks are getting out there and actively investigating education alternatives to get ready for this. And again, based on the expectation before that most of you were more than 12 months away, I think it's the right time to be thinking about getting ready for an IPO and what does that mean.
Yeah, and Matt, on that point too, I think that's pretty consistent with what we see across our client base, where we've got a lot of CFOs that we're working with that that are going through their first IPO or getting ready for it. So pretty consistent with what we're seeing across the market as well.
So what does it mean as a business to be getting ready for an IPO? Certainly prior to the finance organization getting ready, the CEO has met with the investment bankers, and if you're contemplating an IPO, you've developed a strategic plan, and that plan is really geared towards growth in the future. Certainly from an operational and sales perspective, you expect that you've got the right products in hot markets. Certainly, as Jeremy said, SaaS, healthcare are the right markets to be in right now that are growing. One of the things traditionally companies will have is either 8 quarters of profitability behind them, or if not profitability, at least 8 quarters of consecutive growth. So you as the finance organization want to make sure that you've got the systems and processes in place so you can give a certain amount of predictability. Certainly you cannot always predict what the company is going to do from an operational perspective, but from a finance perspective you want to make sure that you've got all the inputs captured, you know the variables, you've done some sensitivity analysis to understand what's going to drive revenue, profits, growth. And certainly a big part of that is having the right systems and team in place. And certainly the team that you need from a finance perspective is going to be controllers, and other folks in the organization that have been there and done that. This is not the time to be learning on the job without the advice of outside experts. So certainly as you look to augment your team and get ready for that IPO, you want to make sure that either your folks internally have done that and been there, or you've got consultants that can fill the gap and help them get there during this pretty intense time period.
So as we work through this, or our discussion today, I wanted to spend a couple minutes talking about the advantages of IPO, why companies do it. These are you pretty much all know these, I suspect. Companies, the big advantages of an IPO is it diversifies your investors and their holdings. It provides liquidity to shareholders. I mean, most of the, or many of the employees obviously have stock options. The VCs or private equities that have funded the company, they want to obtain liquidity, which are very often the key considerations for doing an IPO. Of course, it also raises the company's profile and creates brand awareness. I mean, once a company is public, the market knows much more about it. It's much easier to advertise, raise money. It really kind of raises the awareness and really validates the company's plan and their business going forward. So it even really helps with closing deals and getting customers signed up. And for many companies, pay down debt is a consideration as well. If you've leveraged a lot of debt, particularly now with debt being so cheap, a lot of companies have been borrowing money rather than turning to the equity markets, and it's an opportunity to pay off that debt. So these are, there's a lot of other reasons, but these are pretty consistently the top 4 reasons that always come up in surveys when we talk to people and why they want to do an IPO. Of course, doing an IPO does have its drawbacks. There are some issues to always keep in mind as well. I suspect you all know these also, but kind of the top 4 are also the loss of control and privacy. Up till now, if you've been a private company, you've been able to operate with your financial information kept private. You've been able to, the board has been able to operate very independently and be able to pretty much operate the company as you see fit without a whole lot of interference from outside a small group of investors. Obviously, once you're public, that goes away. Everything you do is known to the markets very, very rapidly, and it really kind of can restrict your ability and freedom to act. Obviously, it also internally, it creates a lot more demands on periodic reporting. You need to now do 10Ks, 10Qs. You need to keep the public informed of what's going on in terms of any announcements, in terms of good news, bad news. And it's a significant expense, not only through the S1 process, but even having to gear up to have the systems and processes in place to produce financial statements, the 10Ks, the 10Qs, monthly financials, and the expense of having the internal controls in place, the stocks that Jeremy was talking about. While some of the requirements have been lessened, there's still a fair amount of work that needs to be done there that needs to be kept in mind. Now, clearly, for the vast majority of companies, the advantages significantly outweigh the drawbacks, which is why most companies do an IPO. But just kind of something to keep in mind. we need to be focused on these drawbacks and being able to focus on addressing those as well as we move through the process.
So what are some of the common things that companies do in anticipation of an IPO to accelerate or increase the value? Certainly acquisitions are a big component of that. A company can go out and do a number of tuck-in acquisitions that would be accretive to earnings. As the company does acquisitions, again, one of the things the finance team needs to think about is what is the significance of this acquisition relative to the total company. If it's big, then you're going to need to audit that acquired company, and going back, it could be as many as 3 years to be included in the S1. And then also within 74 days of acquiring that company, you've got to have those financial statements ready to go on file if it was done post-acquisition. So you want to make sure you have, if you're taking a look at a company to acquire, that their books and records are in decent shape, because if you don't report timely, that could get you out of compliance and really limit your ability to trade shares. Certainly, again, if you do an acquisition and it's significant, you've got to take a look at the internal controls in that organization. Are they going to impact the company's financial reporting abilities, and how are you going to handle consolidation and integration of the finance, just from a reporting perspective, but then also from an operational perspective? If you acquire a company out of state or out of country, how are you going to deal with that? Do you have systems that you need to put in place? And it could create other system issues when you're dealing with segment reporting. Can you produce a full P&L for that business if it is defined as a separate segment? And once you start preparing your MD&As, do you have enough detail about the sales and expenses of that organization so that you can do an MD&A that's going to be reasonably representative of the business on a go-forward basis? And then also there's pro forma requirements that would force you to prepare financial statements that effectively look at how the company was had that acquisition been done at a more distant point in time. Usually 1 year back is the requirement. And then, as John spoke to, other things the companies are doing is refinancing debt or swapping out debt for preferred stock, or taking some debt that has a higher discount rate, maybe turning it into convertible debt. There are a significant number of transactions I've looked at over the last 6 months that have complex convertible, contingent convertible options, and there's some accounting behind that that's pretty complex. You've got to look at beneficial conversion features, whether or not there's an embedded derivative in the contract. And certainly, again, when we talk about IPOs and the need to be predictable, if you have convertible debt and it has warrants attached to it, and those warrants get put on the balance sheet as a liability, we've seen scenarios where that warrant value can go up or down dramatically in any of the future quarters based on the performance of the stock, and so that could have a significant impact, detrimental to the performance of the company, especially if the company's stock is rising. You can get a big hit to the P&L. So again, understand when you're floating out these instruments, what is the accounting consequence, and then being able to model that into the future to what does it look like. And then the top bullet here just talks about reorganizing the business. Certainly you want to make sure that within the finance organization you've got the right folks and team in place, and to the extent that it's material and you've done a reorganization, you want to make sure that you can quantify the benefits to put those separately as an operating expense on the P&L. So again, once the company has gone out and gone public, what are the key stock price drivers? Certainly the non-financial performance metrics, just executing on your strategy is something that the finance organization is not necessarily going to be involved with, although they're going to be feeding the financial information and data to the non-finance teams to make sure that they can understand if they're executing. So obviously putting in the right systems, the right reporting metrics is important. But in terms of the finance, again, it's very important that you arm the CFO and the rest of the organization with the data so that they understand all the levers that are going to influence your profitability. And sometimes you can have pure profit growth, but from an EPS perspective, you might have a flat or declining number for EPS. So you want to have done all the modeling. EPS is a complex area that often doesn't get taken into account until the final hours of preparing the S1. So certainly on a forward-looking basis, that's more difficult to model. And effectively, you just want to help the finance and the rest of the operation team avoid surprises from an accounting standpoint. Again, harkening back to that example of a warrant. Sometimes you'll see companies that are giving their customers warrants, and to the extent that the customer has not yet purchased or met certain purchase levels, if the company's performance is improving, if that customer's purchase levels are growing, you can have significant contra revenue hits. So another example of sort of complex accounting that could come in and untangle or tangle up your revenue reporting.
So I just want to spend a moment talking about some other liquidity alternatives. If you're part of the 25% or so in the earlier survey that kind of researching the process or the groups is not sure, clearly there are alternatives to an IPO. It looks like most of this group is already pretty much down the road or headed towards the IPO, but just other things you kind of always want to keep in mind, that there are some alternatives which we're not going to spend a lot of time on. Clearly, private equity, private placements are two alternatives. This group, I suspect, already has, most of you probably have that private equity already, probably have a lot of those investments. Many companies elect for a liquidity event rather than go the IPO route, basically sell the company itself. Either strategic sale through the M&A market is clearly another means to a liquidity event. That is very, very common for many companies, particularly once they start gearing up for an IPO. And there's also joint ventures and alliances that many companies can find very advantageous to increase the liquidity, increase the value of the company over time, particularly if the IPO market right now is not really, if you're not really ready for the IPO market. These are all alternatives that can provide you liquidity, provide runway until you are ready for the IPO, until the market is ready for your IPO, as the case may be. So don't want to spend a whole lot of time on these, just kind of other alternatives to consider. Because at the end of the day, with this group, it is the IPO that most companies are really kind of gearing for, even if that's not where they ultimately end up. And that's really where we're going to spend the rest of our time today, really kind of talking about the IPO, because it does provide the best valuation, typically access to capital, visibility, and as I said before, the credibility that comes with being a public company is very, very important. So with that, we want to move on and really kind of talk about the IPO process itself, and we kind of really brings us to our next polling question.
All right, our third polling question is, what is the appropriate time to start preparing for your IPO? Is it A, 6 months, B, 12 months, C, 18 months, D, 24 months, or not sure? All right, so we'll give you just about 30 seconds to get your answers in. And do remember that you need to answer at least 75% of the polling questions to qualify for California CE. All right, good. So we're going to close the polls here in 5, 4, 3, 2, 1.
Excellent. Let's take a look at the answers here. Now with this one, there's no real clear, cut and dry right answer. Typically, we're going to look more at 24 months being the correct answer, but 18 months really could be. We see organizations, the ones that want to go at ludicrous speed will do it in 6 months or less. But the reality is to properly pursue an IPO and really have all of your ducks in a row, to really have the best bang, you really need to be focused on this really 18 to 24 months out. So as we transition here to talk more about IPO execution, let's start with touching really on the timeline here. And as we go through the next handful of slides here, part of what we did was reach out to a lot of the clients that we're working with that are either nearing a public offering or have recently gone through one, just to gather their input on what are the things that they wish they would have known as they got started on the process, because of course hindsight's always 20/20. And the resounding first comment that we got back was, make sure you get started early and make sure you don't rush. And this is really where you have to strike a balance between the process by which you go about getting ready for an IPO and a lot of the internal pressures that you're going to get as a finance organization. So starting early, obviously there's the need for capital and the desire to raise capital for future activities, et cetera. That's going to be one of the primary drivers, and that's typically going to be driven through pressure from the board, et cetera. The finance organization really needs to be looking at this, though, and determining how best to balance that pressure with the appropriate process that you need to go through to evaluate where are the areas that your organization may be deficient or not even deficient but not optimized, and what is the plan to go ahead and optimize those functions within the organization. So really, again, looking at this, a minimum of 18 months, ideally 24 months is really what the timeline should be, and that really ties into one of the metrics that Matt provided earlier as well, is the best performing organizations or organizations that are really looking to have a strong response to an IPO are those that have a demonstrated either growth potential or profitability over the previous 8 quarters. This very much dovetails directly into some of the data that Matt provided earlier. So as we look at this, the eye chart that you see in front of you here is sort of a high-level overview that really breaks down into three buckets. What are some of the activities that you should be focused on as you look to move down the path towards an IPO? The first bucket really is going to be your 2 year to 1 year out type of activities, and we're going to highlight these in more detail in the subsequent slides. The second bucket is really a year prior and then post-IPO, because really at the end of the day what organizations need to remember is an IPO is not the end of the journey. It's simply a key milestone in your company's history, and it's a very important one. It's a very recognizable and great achievement to focus on. But the day after the IPO, now you have to get back to work and continue operating as a public company. So let's touch on what some of those activities are more from a 12 to 24-month perspective. So one of the first things that you're going to need to do is establish the appropriate corporate governance, and this can be everything from making sure you've got the right mix of members on your board, making sure that you have the proper individuals on your audit committee, and then making sure that you're starting to put in place the appropriate policies and procedures for the overall management of your finance organization. And while you may have had informal practices over the life of the organization, adding that level of formality this far out is going to be very, very important. In fact, Ernst & Young puts out a very good piece of thought leadership called Measures That Matter, and one of the things that they focused on was what are the key contributors to post-IPO performance. And one of the largest contributors to post-IPO success was organizations operating as though they were a public company for at least 12 months prior to their public offering. So getting these corporate governance components in place and establishing the appropriate oversight is really going to be a key piece of the puzzle. The next one may seem a little obvious, but it commonly gets overlooked this far out, which is evaluating and upgrading your finance organization. And this really can take 2 different forms. One aspect is the individuals that may have been great startup folks that have helped get you to the place you're at may not be the right individuals to take you to that next level. They may not have the appropriate level of experience tackling more complex accounting challenges, even some of the ones that Matt mentioned around warrant valuation and the impact that they can have and some of the complexities around those. The individuals that have helped get you to the point you're at now may not be the right individuals to unto themselves get you to that next level. So evaluating your organization, determining where you may have competency gaps is key. The other piece is anticipating the growth and how your organization needs to scale and trying to get ahead of that. And that's a constant battle that most organizations are going to face, because let's face it, at the end of the day, most companies still look at their finance and accounting function as a G&A function, and they're relatively hesitant to invest in it unless absolutely necessary. That being said, fighting the good fight to try to get ahead of the curve and scale is going to be very key when looking at your organization. And that absolutely blends right into the next point, which is assessing your financial systems and making sure that you've got the appropriate systems that can scale with your business. We touched on scalability of process. That very much ties into scalability of systems. And so from there, that bleeds into, really what should we be focusing on in the 12 months prior to going public. Of course, there's the focus on the registration statement, getting the S1 draft submitted, getting it through and resolving SEC comments, preparing for the investor roadshow, etc. And really, at the end of the day, the other piece that organizations should be focused on as well is the financial reporting capabilities. And again, this is another area that CFOs have pointed out to us that they underestimated the amount of time it would take to balance the S1 registration process with the ongoing accounting requirements, of just running the day-to-day accounting operations. So making sure that you're enhancing your financial reporting capabilities and looking at things like how do we streamline our close process, how do we eliminate inefficiencies, how do we make sure that we can achieve a 5 to 6 day close are going to be of paramount importance as you move towards this public offering. And then last but not least, as I mentioned, IPO is really just a one step along the journey. And once you're a post-IPO, of course, the focus now becomes on making sure that you're streamlined and efficient in your financial reporting. And we're going to dive into this a little bit more as we go through the remainder of the discussion. But did want to point out that this is really where looking at inefficiencies, if you have not flushed all of those out in the pre-IPO space, make sure that you're focused on those here, because timelines that would have been acceptable as a private company are not going to be compatible with the way that you need to operate as a public company. Case in point, one organization that recently went public that we've been working with tackled this challenge pre-IPO, and their close process for one of their major cycles was taking anywhere between 30 to 40 days when we first started working with them. And their primary concern was as they continue to experience significant growth, that close became longer and longer and more arduous. And so they were really looking at how do we get this into an acceptable range where we can meet the requirements to our investors, we can meet the requirements to have our financials completed in a timely manner. So just to illustrate the point that really streamlining and making sure that you're efficient, and that ties right into the last point there, which is continuous improvement. Focus on flushing out the inefficiencies. One CFO that I work with quite a bit said that his key barometer for his process efficiency is how quickly their close operates. And if their close can't operate in 5 to 6 days, then there's something broken with their process, and he challenges his team to go back and look at that. And I think that's a key takeaway from one of your peers, which is looking at the efficiency of your close as a key metric for your organization. And with that, let's move to our fourth polling question.
All right, our fourth polling question is, why is it important to start the IPO process early? A, putting a process in place. B, develop experience operating as a public company. C, eliminate surprises. And D, all of the above. We're going to test to see if you've been listening. All right, so we'll give you a few seconds to enter in your answers. We need at least 75% of the polling questions answered to give CPE today. All right, so we have just a few more seconds, and we're going to close the polls here in 5, 4, 3, 2, 1. All right. Who wants to debrief this one?
I'll take this one.
All right.
Yeah, well, it obviously appears that most people have been listening to what we've been saying.
That's the test.
All three of these items are really critical to a successful IPO and to operating as a public company. Jeremy was talking about putting processes in place, but part of that is also developing experience as operating as a public company by putting the processes in place. Immediately after the first quarter after the IPO is not the time to find out that how hard it is to prepare a Q, to do the close in 5 days, to get financial statements, MD&As together, and all that kinds of information. So you really want to have the time to really kind of do that and focus on that. And also, of course, you want to eliminate surprises throughout the process. So it really was all of the above. But I want to spend a few minutes just digging in a little bit into some of the things that Jeremy was talking about in terms of the people, processes, and technology related to getting ready to not only go through the S1 process, the IPO process, but really kind of focused on post-IPO, what it really means to do that, and why it's important to be able to practice or have experience operating as a public company before the actual IPO. Obviously, the key task that people always tend to focus on is the S1 itself, the registration statement. And there's no doubt that is an awful lot of work. With the companies we're working with right now that are in this process, I think all of the CFOs would kind of unanimously say that they wish they had more time to work on the S1 and make sure they really get it right. Because it always tends to be very much a I don't want to say a rushed process, but a very, very busy time, and really kind of consumes the company for a period of time. And it obviously becomes the key focus on everything. But for the companies that are, they're the S1 and the registration process now, of course, they're very quickly going to drop into the 10K process probably at the end of the year if they're a calendar company. Even if they're not a calendar company, they're going to get into the 10Q. And these processes really drive an awful lot of management attention, and really kind of force the company to really be very, very efficient, as we were talking about before. Closing the books, as many private companies do, in 20 or 30 days, which is for many private companies is okay. Suddenly, when you're a public company and you have to file registration or file a 10K or 10Q, that process really needs to be tightened up. I don't think there's any successful public companies that are closing whose close is not at least 10 days or less. And most companies really kind of set a goal at 5 days to close the books. Now, clearly that takes a lot of rethinking about how your processes work, what kind of people you have, the technology you're using, your ERP systems. But you really need to kind of really focus on those things to really be able to drive that close to 5 days. That really needs to be your goal if you're going to be a public company, because management needs time to look at the numbers. You need time to really analyze and understand what's going on. One of the things that's often overlooked in that process is really becomes the importance of monthly financial statements. Private companies tend to, maybe they even do a hard close. A lot of private companies do a hard close once a year. Some only do it quarterly. And while that certainly, I guess, meets the technical requirements of being a public company, the reality is you really need to close the books on a monthly basis, because in that way you really understand what's going on in the business. It really helps management be able to be ready for the quarter, helps the accounting department be ready for the quarter. As for anyone who's been a public company CFO, the worst thing you can have is have a surprise at the end of the quarter. The markets do not treat that very kindly at all if you suddenly miss your forecast or miss your numbers. And doing those monthly close really kind of helps you focus on those numbers on a consistent basis. Along those same lines, doing budgets and quarterly forecasting becomes very, very critical. As a private company, an annual budget is probably fine. Once you're a public company, those quarterly forecasts, even a rolling forecast, even better, becomes very important, because the market is expecting you to be able to put out earnings forecasts. They expect you to hit those forecasts. And I tell you, the quickest way to become an unemployed CFO or an unemployed controller is to miss your forecast because of an error in an Excel spreadsheet. We've seen that happen to CFOs. It usually results in the board looking for a new CFO. Those kinds of things are just not acceptable in a public company. So so using Excel files, while Excel's a great tool, if you're relying on Excel to doing a lot of your financial statements, your budgets and your forecasts, it's really, really risky because it can cause a lot of real problems. So part of the technology consideration is always relooking at your ERP. QuickBooks is a great accounting system, but generally not for a public company. It just doesn't give you the abilities and the controls, the processes you need to be an effective public company. So you probably need to upgrade that if you're using one of the smaller accounting systems. You don't want to be using Excel or relying heavily on Excel for budgeting, forecasting, financial reporting. You want to be using your ERP system or a tool like adaptive planning to really kind of focus on real processes and technology to really kind of drive those efficiencies to make sure that as a public company you're really operating effectively.
So as the company is getting ready to do the S1, obviously they have to go through, as Jeremy said, likely 3 years of audits. And as a new public company, you've got to be aware of the additional reporting rules. We've listed on this page some of those rules. One of the things to consider is that the SEC will look at any stock options that you have issued in the last 18 months prior to the IPO. And they actually have the benefit of waiting until the stock prices, or at least you put the range of the filing price on the front of your S1. And then once that happens, they then look back to any options that were issued in the last 18 months. And if the prices of any of those options are below the filing range, then there is a presumption that those options were granted at below fair value. So you need to have had in place controls to make sure that you're not encountering either GAAP or tax consequences to your employees as a result of cheap stock. So you want to make sure you've got your 409As done. Some of the other more complex areas for newly public companies are earnings per share. There's, oftentimes you're not putting together an analysis of where your stock was between stock option grant dates. That's some data you need to fill in the blanks. If there's early exercise of options, you need to understand how to add back that dollar amount that was exercised for purposes of implementing the Treasury buyback method. And then pro forma presentation, you want to make sure that you understand which instruments are going to convert upon the IPO. Typically, you're taking out preferred stock, any related dividends or accretion. You're adding that back into the earnings and then dividing by the total number of shares. So that, again, is a common pro forma presentation that you're going to need to be familiar with. And then segment reporting under the accounting rules. Segment reporting is only applicable to public companies. So if you're a large organization, you have different business lines, you need to make sure that you have P&Ls for those business lines so that you're able to report that segment data. Some additional areas that would need to be audited that are new is income taxes. Under private company rules, you're really just responsible for discussing the deferred tax assets as well as the rate reconciliation between your effective income tax rate and the statutory tax rates. Now you're going to need to prepare a full-blown table of disclosure. You're going to need to talk about foreign operations. Once you get into quarterly reporting, you're going to need to understand what is your annual effective rate so that you're applying that on a quarterly basis. Oftentimes, net operating loss carry-forwards are going to be eliminated as a result of significant changes in control, so that's a pretty deep tax analysis. You want to start taking a look at tax tracking in your stock option paid-in capital pool. So there's a huge number of potentially complex areas in income taxes that all of a sudden the audit is going to become much more intensive in this area. So you really want to make sure that you've got lined up, and these are analysis that again take some significant time and expertise. So likely you're going to need to hire an outside consultant and give them a window of at least 2 or 3 months to digest all this information and come back with the right analysis so that you're minimizing the audit time on these issues. Preferred stock, obviously for public companies, there is almost always the requirement to reclassify preferred stock. If it had been sitting on your balance sheet in equity, it almost always moves up to the mezzanine level as a result of change in control, liquidation features. And then MD&A, you just want to make sure that you have enough data coming out of your systems so that you can explain the performance of the company and meet all of the reporting obligations. This is one of the most common areas of S1 comment from the SEC, is that they want more in-depth analysis surrounding product mix and expense fluctuations. So you better be prepared to have that data at hand to prepare the right MD&A.
Excellent. And kind of coming from the audit perspective now to a little more focus on corporate governance, focusing on some of the biggest challenges that we're seeing around here and some of the feedback we've gotten from CFOs. We wanted to touch on corporate governance again just briefly. I've discussed some of these in the previous slides, but one of the biggest things that we look at is, as you transition from a private company to a public company, is the composition of your board and most importantly the composition of your audit committee. Making sure that your audit committee chair is really an individual who can bring the appropriate experience and oversight and guidance to the organization. And I think the really key piece here is making sure that they complement the CFO and the controller in a very positive way, specifically looking at where they may have additional experiences or a different capability set in the financial area that really helps to bolster management's capabilities in that space is going to be very, very critical. That leads right into some of these other, components here as well. Enhancing the internal control structure. We focused on that previously. Making sure that once we have the appropriate organization in terms of the board and the audit committee, having the appropriate meeting and reporting process as part of your corporate governance is going to be critical, because again, this directly ties into some of the components that John spoke to, which is making sure we have the timeliness in not only our financial reporting, but within our SEC reporting, and having the appropriate board and reporting process to support that. And then last but not least, some of the other areas that we've gotten feedback on that create some of the more larger challenges are making sure that the management compensation structures are appropriate and they're put in place and they have the appropriate approval and oversight structures. And then any residual issues regarding, third-party transactions, making sure those are appropriately resolved. Those tend to be a little more challenging in their nature as well. So those are some of the corporate governance things that we really want to be that we would recommend you focus on as you continue down the path of either planning an IPO or looking at performance post-IPO.
Just to emphasize that, I mean, several of the companies we're working with, really kind of wait until late in the process to really start considering independent board members. And, I strongly encourage you to begin that process earlier because they all clearly underestimated how much time that can take. As you said, Jeremy, not only finding the right members who complement the CFO and the CEO, but if you get too close to the IPO, people get a little nervous about joining a company they haven't had time to really understand. So you really want to kind of start that process early, and there is a lot of interviewing, a lot of time that can take to do that and really find the right people. So don't underestimate that and wait too long to begin that process because it can really kind of bite you if you really get too close to the IPO and start looking at those board members.
Yeah, I completely agree with that, John. And to the point of, starting early, just from experience, I think really focusing on making sure you have the appropriate financial expert identified and integrated with the organization. The longer runway you give them, the more they're going to be comfortable, the more they're going to be integrated with management, with the CFO, with the CEO, where you guys are all working as one solid unit. So absolutely starting early is critical for that function. All right, and with that, let's bring it to our fifth and I believe our final polling question.
All right, the question is, the GAAP rules for a public versus a private company are the same. Is that true or false or not sure? All right, everybody's entering their answers pretty quickly now. We're getting close to wrapping it up. All right, we're going to close the polls in 5, 4, 3, 2, 1. Great job. All right, Matt, you want to comment on this?
Sure. So it was a bit of a trick question. The rules for general reporting purposes are the same. So the way you recognize revenue, the way you recognize expenses are typically going to be the same, but there are enhanced or expanded rules that are specific to public companies, and we went through some of those. Obviously, earnings per share is only for public companies. So again, you need to be familiar with all these expanded rules around reporting and disclosure for public companies.
So I'm going to spend just a couple minutes talking about the IPO roadshow. Clearly, this is something that happens obviously at the very end, just after you file your registration statement. And the purpose of the roadshow is really to introduce the company to key investors. You have the underwriting sales force and prospective institutional investors. If you've ever done an IPO roadshow, it can be fairly exhausting because it tends to be a lot of meetings in a very short period of time. But one of the key people you really need to deal with are the skeptics. And I just wanted to kind of emphasize that. Twitter just announced they look at doing an IPO. And if you follow that at all, of course, there's immediately people out there that are questioning whether their revenue model is going to work, how well a company is going to do over time. There's always the naysayers out there and the skeptics that really need to be convinced that the investment is a good investment for the IPO to be successful. So it's just kind of keep that in mind as you're kind of putting all this, everything we've been talking about together. You really need a business plan to be realistic, consistent, and clearly communicated. And doing that requires, it's obviously very helpful to have a good start on that, but make sure you've got the processes in place, the accounting number, the process, the technology, and a lot of the non-financial information in terms of systems and processes, the business plan, the markets. All those things need to be really realistic, consistent, and clearly communicated because the scrutiny that you're going to undergo is going to be very, very intense as part of the IPO roadshow. Because as I say, the skeptics are really going to be looking for reasons to criticize you. So you really need to kind of be at the top of your game throughout that process. So the business plan is really critical. It's kind of where we started this discussion to really focus on that and make sure it all comes together. Jeremy talked earlier about the EY survey, and this is kind of the rest of the story, as it were, on that survey and kind of the top items that were identified of what makes a successful IPO. And it's really, obviously, the answer is not the initial trading, but really how it performs over time after that. The most commonly, as Jeremy said, the most commonly cited reason for a successful IPO is operational excellence. Clearly a part of this has to do with the SOX and the governance kinds of issues, but the bigger piece is just the business overall. I mean, you have to deliver the products on time, the products have to work, they have to be accepted by the market, you have to hit your sales targets, all those kinds of things that are really, really critical to just operating the company, which at a much higher bar, much higher level than you do as a private company. Effective investor relations is often overlooked because that really provides the investor community, they're really the bridge between the investor community and the company, and it's really all about trust. If the market doesn't trust what management is saying, what the company is saying, the information it's putting out, it's not going to bode well for the stock price. So really having that investor relations, which we didn't spend a lot of time talking about, but having an effective investor relations organization is really critical. Where we actually spend most of our time, of course, is in the finance function. That's very commonly cited by 45% of the people because the numbers need to be right. As I'm sure you're all very much aware, I talked a little bit about what happens if you miss your forecast, but just as bad can be if you have to restate your financial statements. If suddenly you have to go to the market and say, oh, our revenue was wrong, we miscalculated some expenses, or any of those kinds of things can be obviously very detrimental to the stock price and really hurt the company's credibility, not just in the short run, but in the long run. Acquisitions, corporate development are critical, as in, of course, the company's ability to innovate, as we know, particularly here in California, in Silicon Valley area, where innovation really is what drives the business. We see that things in those companies that are highly innovative, like Apple and a lot of technology companies, that really kind of drive that. That's really what drives company value.
All right, so thank you, John. Today we've reviewed recent activity in the IPO market and how companies are utilizing the Jobs Act, and we've also looked at IPO as a strategy for growth, the advantages and the disadvantages, and looked at the key steps in the IPO execution process and timeline review. And then finally, we're looking at the post-IPO success and key considerations for a successful life as a public company, including good governance measures. So we hope you got a lot out of today's webinar, and we're going to move to the Q&A feature. So if you've got a question, type one in real quick, but we've got one here for you guys. Maybe the three of you can comment on that. So the question is, what is the biggest change a CFO can expect after going public? John, you want to comment on this one first?
I think that from what CFOs I've talked to, the biggest change is really just the tremendous amount of increase in public scrutiny. It's a whole different ballgame once you have to respond to the public market. The timelines get much tighter. You now have quarterly earnings pressures, which can really play havoc with the way a company and a CFO operates. So I think is probably the biggest change, is the increase in scrutiny and process throughout.
Yeah.
Yeah, I would agree. I think it's the fact that you're no longer just reporting to your board that may be made up of your investors, et cetera, whether it be venture backed or private equity. Now your investor base is far broader, and the scrutiny that's going to come along with that is significantly greater. I know in speaking with CFOs that I work with, that's the biggest sort of shock. Is while they expect it, it's expecting it and then being in it for the first time are very different.
They get a lot less sleep.
Yeah, a lot less sleep, especially around this time of year, quarter end.
All right. Well, I think that takes us to the top of the hour, and on your screen you have an opportunity to see the contact information for Matthew Peralt, John Dunnigan, and Jeremy Suharski, and we really appreciate you tuning in today. And if you want to contact these folks about any questions concerning some of the information, or if we can help you out, give us a call, and we thank you again, and have a wonderful day.